Good morning and welcome to Bazaar Morning Call. I'm Anuj, with me Sonia and Prashant. As you saw in that montage, the Fed maybe having the last word. Yesterday we were saying that fed up of Fed, maybe the Fed didn't like it and just gave us a bit of a reality check. I'll put some basic, points on table and then we'll take it from there. This is now the most tightening spree that the Fed has been since Paul Volcker in the 80s. And that's the big question, is this Paul's Volcker moment? Because the market's fear is that they did underestimate the rate hikes. 75 happened, and logically the market should have been relieved that it was not 100, but the commentary. And I think I just want to put a picture here. This is a picture that I read in the morning. This is the 50-year history of US monthly inflation versus the Fed fund rates. Why is that important? Is that once you start to cross a certain threshold, it doesn't come down till the Fed fund rates actually go over the inflation, or inflation falls below Fed fund rates. Inflation in US is at 8%. The Fed funds, even after the hike, are at 3.75. So I'm not saying that we go all the way there. Of course, inflation will also fall at some point. But that is the big worry. Back home, of course, we have been resilient. It's well documented that our market is best performing market. But does that get tested, especially with the way dollar index is also surging? Finally, do we participate in the risk of, I think, Sonia, Prashant, morning. This is the big question that I'm asking.
Absolutely. And so many questions, right? I mean, Anuj, Prashant, morning. It's the third straight big rate hike, right? 75 basis points 3 times in a row. There was this joke doing the rounds that why don't they just hike it by 200 basis points in one shot and then cancel all the Fed meetings to come, right? But I mean, Anuj, a couple of points stood out for me, and of course, Prashant will take it forward in greater detail. But the main message has not changed since the Jackson Hole meeting. That was the big statement that came from Jerome Powell. A 75 basis points rate hike has come through. There are more planned to fight inflation. The Fed is resolved to bring down inflation to 2%. So, until that target comes through, there are plenty of rate hikes on the cards. Of course, most global markets were under pressure, and the Fed could hike as high as 4.6% before ending the inflation fight. But a couple of big questions from an Indian investor standpoint, right? Now, since this Fed hike is out of the way and we by and large know which way this trajectory is going to move, will this bull market that we're in, will it resume in India now, or will this pause continue? That's the first question. Since the main message of the Fed has not changed, and remember, there was expectation that could be a 100 basis points hike, and since that has not come about, is it in some way a bit of a relief for markets like our own, which have been moving on their own, speed? So, Anuj, these are the big questions. I mean, now that this large event is out of the way, do you think the market will move on, or will it sort of, move in tandem with the global markets, take a bit of a pause? That's the million-dollar question, right?
It is maybe a billion-dollar question. Sonia, we don't know if the event is out of the way because we don't know how many more rate hikes will happen. So I think that is a big question. I think back home, we are going through the process because at the end of the day, you have to trade the Nifty at 915, right? Doesn't matter what happens overnight, SGX, Nifty and all of that. The big question that you have to answer is, what do you do when the markets open at 915? Now, our market has been going through some bit of cleanup of excesses over the last couple of days. It's visible on the Nifty, but more visible in the market breadth. Now, the larger trend has been buy the dip, and I think that's intact till 17,240 holds out on closing basis. That has been a very strong support for the market. So I think till that is there, the dip is a buying opportunity. For today, how do you approach it? I think for today, simply you keep the SGX Nifty low as the first reference point, because what I have observed is on days like today, the market normally does not violate the SGX Nifty low. It does not open as bad. And if it does, then, in the first hour, it actually makes some kind of a low which does not get breached, because shorting after this kind of a decline is not a good risk reward. The market, of course, the Nifty opens below the 20-day exponential moving average, which is 17,700, way below that. So in terms of the next big support, that comes in at the 50-day exponential moving average, which is at 17,340. Yes, it's quite deep, but then, that's the kind of the market that we have. Intraday recovery, if it happens post the first hour, has to be led by the Bank Nifty, which is very strong. And I think IT index today could actually test its 52-week low. So in terms of the Nifty Bank, the first level to watch is the 10-day exponential moving average, which is 40,800. And then the 20-day exponential moving average, which is 4220. What I'm trying to say here is that in this zone, the Bank Nifty normally anecdotally bounces back and gives you a good risk reward. Whether it changes or not, we'll find out. But the market's message has been that if you buy in this zone, you normally make money. The FI data is very interesting. Yesterday it indicated that after 3 or 4 days of short covering, shorts re-entered the system, not just via futures, but also via the options. I think that could just be a play for today because today's weekly options expiry. So maybe that was playing for that gap down. And let's see after the gap down if these shorts cover or actually let them run till 3:30. I think that will be, for me, the fascinating story. But let's now revisit the big story. And Prashant has, of course, walked across to the big wall. Prashant, did you get some sleep? And what's been the key takeaways?
Well, thanks very much for that. So the big event is out of the way with largely hawkish implications. Let's get to it then, right? And I'll break this down in 10 points. So number one, the Fed has delivered a third consecutive 75 basis point rate hike, which is in line with market expectations and consistent with recent Fed communication as well. Number two, while there were no major changes to the statement, the summary of economic projections showed a sharp increase higher in the federal Fed funds rate. These are projections of what the Fed sees its own Fed funds rate will be by the end of the year, by the end of next year, and so on and so forth. Number three, the median for 2022 in terms of these rate projections was taken for the end of this year from 3.375, that is 3.4, to 4.4% nearly. What this implies is important. Consider this. This implies that the median participant on the FOMC committee is looking for another 125 basis points of hikes in the remaining 2 meetings of this year, that is November and December. That is significantly higher. Number four, the 2023 dot, which is next year, went from, these are, again, I'm saying projections for where the Fed sees its own Fed funds rate at. It went from 3.75% so far to new estimate of 4.625%. This implies another 2 hikes next year beyond what they expect the Fed to deliver by the end of this year. On top of that, the 2024 and 2025 rate projections show modest gradual normalization. They expect rates to come down to about 3.875 and 2.875 as well. But even these rates are in the restrictive zone. We're talking about 24-25. Number five, Fed Chair Powell's first answer to the question in the press conference was prefaced by him with this comment. But even before he took the question and began answering, he said, "The main message for me has not changed at all since Jackson Hole," end of quote. So he wanted to make sure that there is absolutely no confusion what the focus for the Fed is, which is fighting inflation and bringing it down to 2%. Number six, these are economic forecasts now. Just like there are rate projections, there are economic projections as well. They were also revised, but mostly in a more pessimistic fashion. Why? Number seven, unemployment rate projection for 2023 and 2024 is now expected at 4.4%. This is an upward revision of about 0.5% and 0.3% respectively. The other projection is the growth projection for 2023, which was revised down, while inflation projection was revised higher. So it's the opposite of what you would want to see. Growth is being revised lower, inflation is being projected higher, and rate forecasts are moving up as well. Number nine, Powell in his prepared remarks, this is the statement which he reads off before he takes questions, highlighted that the restrictive stance of the policy is likely for some time and that history cautions strongly against prematurely loosening policy. This was the one big notable change from his July policy statement. Otherwise, there wasn't very, and this change is relatively at the margin hawkish. And last point, number 10, in the press conference in response to a question as to what will cause the Fed to slow or pause these rate hikes, right? Powell outlined 3 conditions: below trend growth, softening in labor market, and a clear evidence that inflation is moving to 2%. I mean, to summarize, I would say that this Fed meeting outcome has managed to surprise even the raised bar of hawkishness. The street and the market will have to play catch up with the Fed. Back to you.
Okay, thanks a lot for that. So